All right, welcome back to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. This week, we're talking about what I believe in real estate today that I didn't believe 20 years ago. And ultimately, where we want to go with this show is we want to talk about some, how would you say that? I don't want to say misunderstandings is not the right thing. Maybe not. Maybe where our focus was wrong, right? Where what I didn't believe 20 years ago has changed through experience. But we wanted to talk about how our real life examples of our own journeys in real estate have shaped what we believe in real estate to be true today.
Yeah.
So, Tim, this was a great idea that you had suggested for us to talk about. I'm really excited to kind of dig into this one. So, how you doing this morning?
Not too bad. Can't complain, right? Um, always good when you wake up on the right side of the dirt, right? Um,
Yeah, not 6 feet under is a positive start to the day.
yeah, yeah. So, guys, like, listen, it's not about places we were wrong, right?
Mhm.
It's more about just things that experience teaches you over time. And quite frankly, if it was things where it's like you're wrong, it's like, hey, that's exactly why you do things, is to find out where you can learn and not make the same mistakes before. So, it's not about not admitting fault or wrong or anything like that. It's just like, hey, listen, we're just being open about things we've learned along the way. And Tim, I think one of the biggest things for me was, not going back 20 years, but let's just talk about multifamily for a second. When I was doing multifamily, when I first started, I thought everything I thought everything needed to be capital and pipeline, right? Like,
Yeah.
that's what I needed to go build, right? Is capital and pipeline. And I did. And it was very beneficial, not gonna lie. Extremely beneficial. Guys, we scaled up pretty fast. What was it, like 24 deals in like 28 months or something like that?
Something
Um,
like that. I mean, the bulk of it was in 2024. That was,
yeah,
what did we it was a 14 property portfolio, and then there was a couple towards the end of the year.
yeah. And one of the things I think that's really, really kind of reared its head, and I think a lot of people are having these aha moments. I mean, hell, I see Fearless posted about it. I see, oh God, who's another big one that's out there right now? The hell, Brandon Turner.
Mm,
he's 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 one of the big ones that's kind of out there going, oops. But guys, like, buying the deal is just day one, right? Operating the deal is where it's at, right? That lasts years. And I think a lot of people kind of miss that part. I know I'm not going to say we overlooked the operating part, because we definitely did not. But we had a ton of focus on buying and acquisitions and capital raising and things like that. It's like, hey, you definitely need to be focused on that. But at the end of the day, operations is priority number one.
mhm.
I don't think you can say it another way. Um,
Yeah, I mean, yeah, when we first started, or when I first started, when you're looking up the mountain that you have to climb of buying your first multifamily deal, it looks astronomical, right? And those first
yeah,
conversations of raising money and pitching deals are uncomfortable, but that's a muscle that you can grow and gets easier in time with experience. But the hardest part is not buying the deals and raising the money. That comes with relationship,
yeah,
expertise, um, and kind of perspective. The hardest part is hands down the operations, because that is a day to every single day.
yeah,
It never goes away. The operations of your business,
right,
and I'll say that I had a pivotal shift maybe 12 months ago, that instead of calling, like I used to say, well, we buy real estate deals, right? We buy deals and we raise money. That's what we do as a business. No, we run a property management operating business, day to day operating our portfolio. And when the right opportunity comes along, we have the ability to add it into our operational portfolio for economies of scale and to provide investor returns, right?
yeah,
And it's the same, but it's different, right? It's like,
yeah,
the primary focus is now the operations on the day-to-day, expense management and capex management and team management. And it's less of a focus on actually buying a deal. Now, when a deal does show up, We look at it, we underwrite it, we make an
Yeah.
offer, but like I'm not grinding to build relationships with brokers anymore, right? Because I mean, that has I don't want to say that ship has sailed, but that part of that journey is kind of riding its own success at this point because of the
Yeah.
work and effort that was put in on the front end. But the latter part of that is they know they can bring deals to us. I don't have to establish myself of who I am or who we are as a company. They know what we do and who we are. They know our track record. And if a good deal comes along, we will buy it, right?
Yeah.
It's isolating those good deals is difficult. I mean, I'm literally texting a broker this morning about a deal that they sent me, and I'm just like, dude, I'm like 40% off what you're saying they want. And he was like, well, I figured you'd be 20% off of their ask. And I was like, I'm not even close to
Yeah.
coming to the returns that I even potentially need to make to for investors at 20% off their ask. I was like, I'm looking at it and I literally sent him the screenshots of my underwriting and I'm like, tell me what I'm missing here.
Yeah.
But I'm thinking I can sell this thing in 5 years for what you're asking for it today. In
No
5
thanks.
years.
Yeah. Yeah. And that's kind of where we get to, right? I mean, those are some of the lessons you learned as well. But I think really tying it down to like buying a deal versus operating a deal, right?
Yeah.
I think if you're looking for a way to sum that up, it's like, hey, anybody can buy an apartment complex. Making it perform for 5 years, that's the real job.
Yeah,
Um,
yeah. Anybody with enough net worth, liquidity, and money for a down payment can go buy a property, right? Like
yeah,
that was one of the ways that I like to think about single family investing was there is a ton of property for sale. Log into Zillow. There's a
yeah,
ton of stuff for sale. The same is true for commercial real estate, but being able to identify a good deal takes talent and expertise and time to develop because as much as I wanted to believe that there wasn't an emotional attachment to commercial real estate, that it was purely numbers driven, that your NOI divided by your cap rate equals what the property value is so far from the truth. Like it's just there's so much emotional attachment there where like I want this number, right? And just like single family, residents are the same way in order to maximize their returns. But it is anybody can go out and buy a deal to your point, but
yeah,
operating it well, producing cash flow, and being able to weather the ups and downs of day-to-day real estate ownership, that takes
yeah.
time, patience, and operational expertise.
100%, 100%. Here's one that I learned, especially in the multifamily space. In the single family space, not as much, right? But definitely in the multifamily space, there was this idea that bigger is better, right? Um,
Yes. Oh
I
yeah.
think I think one of the lessons that we've definitely learned, right, is bigger isn't always better. And and I can remember sitting in Cincinnati at an event with Ash Patel, and Ash and I were sitting at a table, and these guys, there were guys around us, and they were like, "Hey, what do you? I'm looking for 100 units, 150 units, 200 units for their first deal."
Hmm.
And they were like, "Yeah, because you get scale." And I just had this moment, and I was like, "You know what else scales? Problems."
Problems. Yeah.
Um,
Cash needs.
and Ash was sitting across from me. He goes, "I think a lot of people miss that." He
Yeah.
goes, He goes, when you fuck up on one property, you got one door worth of problems. When you make that mistake across 100 doors, well, that's scale.
Yeah, that's
um,
scale, right?
yeah,
Yeah, the problems also scale and the dollar amounts, and like on paper it's no big deal, right?
yeah,
It's it's fine. But you start putting it in bank account terms and you're
yeah,
like, where does the money come from? Let me tell you about stress.
right, right, guys, because and again, I'm not dissing multifamily at all. That's where we
Mhm.
are. That's where we play. I'm just talking about like keep the frame of reference in mind here. Like let's think about it. Like you got a let's say you got a 10 unit portfolio of single family homes, and one of those isn't rented, right? Or you messed up on one, and you didn't think about something just right, and it's taking longer than you expected. I mean, what are you looking at? Like 15, $1,600 a month carry, right? Like,
Mhm.
right, for that mortgage or whatever it is. But I mean, do that on a 100 unit property. You may be looking at a 56, 50, $60,000 a month carry, right?
Yeah.
Um,
More money than most people make on an
right.
annual basis could be your monthly interest payment.
Yeah. How long does it take to run through your cash reserves at a $60,000 a month clip? Right.
Yeah, not long, right?
While you still got all those other expenses to pay too that you planned for.
Yeah, right.
um,
Not long. It goes
yeah.
out faster than it comes in.
And you know what? You know what's interesting, man, is over the weekend I saw this. There's a big apartment group out there on Facebook, and somebody came in and they were like asking, "Hey, what site for my first deal? What should I be looking at?" Right? And there was all these guys in there, and they were like 100 units, 100. They were just throwing out those stock answers, right? 100 units, 100 units, 150 units, 80 units, stuff like that. And finally, one guy came in and he goes, and I thought this was the greatest advice I'd seen in a while. He goes, I think you should ask these people that are giving you advice about their experience. He
Mm,
was like, everybody's coming in here and they're throwing out these numbers and you're taking them. Like, you're like, oh,
mhm.
thank you, blah, blah, blah. He's like, you should ask them their experience. He goes, because let me tell you, and he kind of goes into his background a little bit. He's like, I've owned a ton of units. I've been doing this for 20 years, et cetera, et cetera. And he goes, when I look across my portfolio right now, what I can tell you is performing is not my biggest deals.
Nope.
He
And that's
goes,
true for us too.
yeah, yeah. He goes, what's performing for me, what pays me consistently monthly are a couple of small JV deals that I'm in. They're 30 doors, 35 doors, 40 doors. And he
Mhm.
was like, but my big ass syndication deals at 150, 200 doors, if there's anything in my portfolio that's struggling, it's those.
Yep.
And
Yep.
it was just interesting because I'm sitting there reading that and I'm like, that's true. That
Mhm.
is true.
Yeah.
Uh,
And I mean that, that kind of backs into some of, I used to think that, deals would always they could pencil out a certain number, right? And that's true. But at the same time, it's trying to predict what future values and future expectations could potentially
yeah,
be and really building into conservative underwriting. Like I used to think conservative underwriting was decompressing the cap rate 10 basis points per year, which is true, right? But even more conservative underwriting now is looking at your exit price per door assumptions and saying, is that reasonable or not?
mm, yeah,
Right.
yeah,
And that reasonability piece, because like you could slap a cap rate on any NOI and say, well, this is what it's going to be worth, but it doesn't mean that's what the market is going to be willing to pay. And my
right.
argument, I have learned that my argument is just because you can underwrite it to this expense ratio doesn't mean that you can actually do it or that the next buyer is going to also assume the same level of expense ratio. Right.
Yeah, and guys.
And you can
Oh,
artificially inflate the property value by just, reducing some of your expenses, increasing your income, decreasing your cap rate, like, holding true and steady to actual factual data, which, I used to think going bigger and bigger is always better, or casting a wide net across a large portfolio or a large area was better. No, what I have learned is that the more targeted, the more specific, it gets easier to say no, but it also helps me weed out, the BS. Like I have great relationships with all of our brokers. So do you, right? And a lot of people do.
yeah,
But at the end of the day, the brokers work for the sellers and they're
right.
trying to get the highest price per door. And I have to consistently be willing to tell them, I respect what you're saying, but I don't agree with it. And more often than not, somebody else is going to come in and buy that deal because they got more money and,
Yeah.
and trust in their underwriting, but it doesn't mean that they're going to be successful on the deal.
Yeah, guys, because let me tell you a little secret, and I'm not trying to offend anybody. This is just normal, right? The same broker that's going to sit down when he's trying to sell you something and pitch you on the cap rate and pitch you on why that's a great deal is the same guy when you're trying to sell something that's going to sit down and talk to you about cash flow
Mm-hmm.
and why it's going to be tough to get this number because the cash flow doesn't support it, right?
Yep. Yep.
And hey, listen, that's just how it works because, like Tim said, when the broker is selling a deal, their job is to get that seller the highest number they can. Their job when they're selling your deal is to make sure your expectations are in line. Because
Mm-hmm.
the last thing they want to do is when they take on your deal is not hit the number they told you, right?
Right.
Uh, so it's
Oh,
so you gotta like Tim saying when they bring you a deal, be willing to sit there and stand firm, right? Like guys, I
mm,
can't pay this, right? I
yep.
cannot pay this because cash flow. right? Because cash flow, right?
Hmm. Hmm.
that's that's which is a great lead into this next piece that I want to talk about,
Mm.
because I
Oh, I
think,
think I know exactly where you're going.
yeah, maybe we'll see. So, because I think this is huge. And somebody told it to me a while back, completely unrelated to real estate. It was just business, right? It was a business comment they made to me, and it was cash flow. Cash flow pays the bills. Appreciation is awesome, but cash flow pays the bills. Give me cash flow, I can survive another day. I remember sitting at a Starbucks talking with a couple of guys who had just sold their business and started another one. And they said, day one, you got to stay focused on cash flow. Because if you give me
Hmm.
cash flow, I can make it to tomorrow.
Yeah.
And when you're running a business, being able to survive is priority number one, right?
Hmm. Yeah. Where
And
I thought that. Oh, sorry. Go ahead.
yeah, I was just going to say, and I think there was this run from like 2020 through 2023, maybe even further back than 2020, where folks just, it was all about appreciation. Like, let me build some reserves, and let me build 18 months of reserves so I can get to this number and then sell for that appreciation, right? And it worked till it didn't, right?
Mm.
uh,
Yeah, I thought where you were going to go with, which is kind of the same mindset, was the I used to chase returns, but now I chase predictability, and that
oh
directly
yeah,
ties back to the cash flow, right? Is,
yeah,
I used to underwrite for overall equity multiples, and transactional volume was high and equity multiples were high, but at the same time, now that that's flipped upside down, the predictability has been
yeah,
removed, right? Because cash flow's gone down, debt's gone up, property values are starting to stabilize, I would say, at price adjusted levels with new tax and insurance dollar figures and income figures and all that kind of stuff, which is interesting to see. Um, and it just the predictability of cash flow is always going to be there with long-term fixed rate debt, right? So
yeah,
if you're
yeah,
underwriting to a 125 debt coverage ratio day one with a value add component, you should always be able to pay your debt and continue to cash flow, right? And correct me if I'm wrong here, Tim, but I would say that the most stressed I've ever been in my entire life was when we had multiple cash flow negative deals on high rate interest bridge loans that had to have a value add completed in order to refinance successfully.
yeah. And guys, keep
Which
in mind, he's not even talking about floating rate bridge loans, right?
mm-mm. No,
He's
we
talking
only
about,
did one of those, and I learned my lesson.
yeah, he's not even talking about floating rate bridge loans. He's talking
Mm-mm.
about just a high interest bridge loan that we had a timeline where we had to hit a window,
Yep. I
right?
had never been more stressed in my entire life except for that, like,
Yeah,
18-month window of when all those loans were starting to come due, and we had to extend and negotiate extensions, and may or may not get an extension type of thing, right? And thankfully we did. But I'm so thankful that that part of our life is past, and now I have a different perspective of. I used to think that buying with bridge loans was the best thing in the world because you can get in there with high leverage and do your value add and refinance and put it on stabilized debt. And
yeah,
that's true, but I've learned that you have to take that in, spoonfuls that you can swallow, right? It's
yeah,
having one or two of those deals going at the same time, not a big deal. Having 12, not a great idea.
right. And I think for me, that was an extension of the lesson I learned in like 08, 09.
Yeah.
08, 09, I learned fixed rate debt, take it.
Yep.
Because and the examples were egregious then, and because it's like, that was a time we didn't see 2% interest rate or 3% interest rates, but I mean interest rates were low, and then people were taking these like 2-to-1 arms or 12-month arms instead of taking what was a really good interest rate, and then they
Hmm.
were screwed, right? And when 2008 and 9 hit, their arm adjusted and they couldn't afford it, and but had they taken the traditional 30-year or even a 15-year fix, they would have been fine.
Yeah.
um, but same thing moving forward. So that taught me, hey, stay away from adjustable rate debt as much as possible. That taught me that. But what I learned moving forward was what Tim's talking about, is like, hey, bridge loans have a place,
Hmm.
but they're not. It's not a tool that you just put out there. right? Like, and
Mhm.
you deploy widely, right?
Yeah. No, no, it's
Yeah,
on a singular basis at best.
yeah, and I think you kind of put it. We talked about cash flow and going into like chasing returns and things like that, and I think this is where my head has adjusted quite a bit. Is like, hey, I'll chase that 25% return on a deal, right? But give me the 8 to 12% consistent return, low
Mhm.
risk consistent return on 90% of what I'm doing, and I'm good,
Yeah.
right? I
Right,
don't
right.
I don't I don't need half my portfolio chasing 25% returns.
No,
Um,
no, no, because, yeah, I have learned that, investor expectations are much more narrow than what they think they are,
yeah,
and, with all of this kind of culminating into when things are not going the way that they should be going, everything rolls up to Tim and Tim. Investor returns, debt refinances, cash in refinances, operational challenges with personnel, hiring and firing and ensuring KPIs are being met. All of that stuff rolls up to Tim and Tim, and I can tell you that is a lot less stressful on ourselves, but also everyone that works underneath us as our operational team to support the properties and the investors when things are predictable and stable. It's when you
yeah,
have that unpredictable fluctuations in cash flow and values and distributions and all that kind of stuff. That's when you start getting a lot of questions. That's when people start getting upset, whether it's investors or partners or people that work for you or whoever. Like it can be a very stressful, difficult time. And I'll say I'm thankful that I've learned that lesson. I'm also very thankful to be vastly through the large part of that, tranche of our real estate portfolio. At the same time, I know that the next 25 years of my investing career is going to look entirely different than it did the last 5.
yeah, 100%. And I think that's a good transition into this because I think we're coming up close on time. But here's one that uh, I learned back then. Wealth isn't built on great years; it's built on surviving the bad ones. Um,
Ooh, that's a
and
good one. I don't think I've ever heard
it,
you say that before.
Yeah, that was one I wrote down one time, man, because like I've talked openly about some of the I built a pretty nice little bank account. Oh 06, oh 07, first half of oh 08. And then I went below the floor of that bank account in oh 09 and 10. Um, guys, I lost money. Is another way to say that. I lost everything I made and some. So you think about it, it's like, hey, I built a nice little nest egg and then I lost it and more. And I think that's what people miss, right? And guys, you can see extreme examples of this if you just go back and you look historically at like some of the wealthiest people in this country, right? Like some of those families from the industrial age, it's just a name today. It's not a wealthy family anymore. You're talking about
Mhm.
guys who were like billionaires back in those days, right? Like the
Yeah.
equivalent of a billionaire today. And it's like, how 100 years later does your family not have any money? Well, because they built it on boom years, but then they lost it making stupid decisions, right?
Mhm.
You
Mhm.
can lose everything and more in a few bad years.
Yep.
Then
That
you
took you
then you can
generations to build.
right. Like you can lose it real quick. And
Mhm.
I think that's something people miss, right? Is like, hey, I did great I mean, you see some recent examples of this. I did great in 21 and 22 and 23, and here we are in 26, and it's gone, right?
Mhm.
Right? There's guys out there right now, like I lost everything already.
Mhm.
Tim, I think you and I mean, not naming any names, you and I had a conversation, I think, like 2 weeks ago about a guy who had built up this nice portfolio, this nice, net worth and all of that stuff. And then he kind of disappeared for a little bit. And then he
Mm.
just recently came out and was like, guys, I've been gone. Here's what happened.
Yep. I
I
lost
lost
it
it all.
all. Yep. Yeah. Yeah, yeah, it's funny how I don't wanna say it's funny. It's not fortunate in any way, shape, or form, but
No.
those stories are becoming more and more common, right? It's like a lot of people that
Yeah.
you saw all over Instagram and Facebook and LinkedIn, they haven't posted in a couple years, and lo and behold, they, kinda surface their heads and they're like, "Yeah, I had 100,000,000, 200,000,000, $300,000,000 portfolio that we bought and built and lost it all, in the matter of,
Right.
a couple of bad months or a couple of bad years. And, a lot of that's come down to some changes that you can control, some that you can't, but the ability to be conservative enough to say no, right, more often than you say
Yeah.
yes.
Yeah.
And don't try to put a square peg through a round hole.
Yeah. No, that's a really good way of saying it. I think those are kind of the big ones for me.
Yeah.
I
Yeah.
mean, there's always, I think we talked about, basically hit around like don't chase bad deals and stuff like that. And,
Yeah.
um, kind of hit on the fact that, hey, success isn't necessarily owning the most doors. Right.
No, 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 no. Yeah. It's definitely owning the most profitable doors.
Yeah.
So all right,
But
guys. Well, we're coming up on time. I appreciate everyone joining. Hope you learned something from our perspective. If you got any questions, drop it in the chat, and we'll hope to answer some questions directly for you. So appreciate you, and see you next Tuesday.
see you guys.